Hello trade pros. In today's video, we're going to talk about the relationship between China and the US and the latest trade war. Let's start out by taking a closer look at China's development and how this has caused problems for the United States and the global economy. This is a very exciting video. Let's dive right into it. Before we begin, I want to tell you about a special resource we've put together for you. On our website, we have a blog post that's constantly being updated to take into account the latest development in the China and US trade negotiation and trade war. To visit this resource to get the latest, including our analysis and how we think it's going to impact the market, click here and check it out before we get started. Now let's dive in and let's talk about the China and US trade war. Before we start out with the trade war situation, let's take a little bit of a deeper dive on China's amazing growth story and how we've gotten here to begin with. China has been faced with dizzying growth. In 1990, China was the 11th largest economy in the world. It was roughly 7% of the US GDP. In 2009, China officially overtook Japan as the second biggest economy and now represented a whopping 61% the size of the US economy. But how did China get all of this money? This starts out with what's called as fractional reserve banking. This is the concept that a central bank creates money and circulates it to its banks, allowing them to lend that money even further. If a central bank creates $100 and lends it to an institution, that institution is only required to hold as little as $15 of that capital on reserve. The remainder they're allowed to loan and create additional debt. And with just $4 trillion using fractional reserve banking, China created over $20 trillion of bank loans. In fact, bank loans in China grew at an annualized rate of 18% since 1992. In 1991, the ratio of bank loans to GDP in China was 90%. Today, it stands at over 140% of the GDP. That means that China has more loans than their gross domestic product for one entire year. But where did this money come from in order for them to generate that kind of currency? A lot of this came from direct investment from foreign corporations, as we'll take a look at in a moment, in the form of deposits. In addition to that, because China's been a large-scale producer for much of the world and the grown economies, it's been able to generate a windfall profit from their trade surplus on an annual basis. In fact, China has run a trade surplus every single year since 1990s. So how did China spend all of this money that they received from direct deposits from foreign corporations and investment banks and institutions to their own trade surplus capital that they received? Well, what they had to do was actually convert the capital to US dollars. The reason they converted all of this money is because the reason they converted the money was to keep lower pressure on the yuan. By selling the yuan from their trade surplus and purchasing US dollars, they're able to keep their currency artificially low while converting their assets into a safe haven asset like the dollar. So China had a lot of dollars as a result of the trade surplus. What did they do? China began to invest that money as follows. So what do you do with a whole bunch of US dollars in your bank account? You have to begin purchasing US denominated assets in order to diversify and invest your assets. So what did China do? They began to purchase US treasuries. Treasuries are bonds issued by the United States government in exchange for a promise of a repayment plus an interest payment along the way. This money that was generated from selling treasuries in the United States went towards financing the government budget. Healthcare, such as Medicaid, Medicare, military, which is defense spending, infrastructure, and all the other projects that you enjoy as a citizen of the United States. So this money was collected from China because they had a surplus of US dollars, and China financed the US government as a result of their net profit in USD. As you can see here, China actually owns over $1.1 trillion of US treasuries, about 17.3% of the total foreign investment into the United States. The second largest is Japan, standing at 16.5%, and Japan is also a massive creditor or financer to the United States budget. Now, along the way, China developed a really big problem. The problem was Between 1980 to 2015, China's population grew by 386 million people. That's roughly 118% of today's population in all of United States. And China's population currently stands at 1.37 billion people as a total. So what's the issue with having a large population growth? This population needs employment. They need jobs. They need to work. Here's where China thought it's time to create jobs. How do we do this? Between 1980 and 2015, a total of 351 million jobs were created by China by using their export advantage. Real wages grew by an annualized rate of 10% since 1998, a massive boom for the everyday Chinese citizen. But how did this grow? How were they able to create so many jobs? What did China do with their capital to create employment opportunities? The answer to that question is investment. China took the money that they generated from their trade surpluses and returns on investments and invested domestically in their country. They were able to put that money into infrastructure such as railways, highways, subways, airports, telecom, and other industries developed as a result. Construction in China was also a massive area of investment by the Chinese government. In fact, between 2011 to 2013 alone, China produced more cement to fund their construction projects than the US did in the entire 20th century. This was a massive boom in terms of infrastructure and development. However, the dark side to this development was that while a lot of jobs were created for the booming Chinese population, the average wage was just $8.13 US a day in 2015, much lower than the average global median income. And this was in part responsible for being able to create lower cost goods that they would export internationally, making their products more attractive to global consumers. In 2015, the Chinese economy hit a slow patch and it began to contract. The growth rate declined, and as a result, it caused a flight of capital away from China. Because money was leaving China, they sold the yuan and investments they had valued in the local currency, the yuan, and that selling put downside pressure, directly affecting the value of the currency and causing it to be worth less, or devaluing the currency as money fled from China. When the money ran away, it had to go somewhere. Traditionally, the US dollar, because it's the world reserve currency, is a good safe haven during times of turmoil. The weakening yuan, because of the capital flight, resulted in that money being invested in the US dollar, simultaneously pushing the value of the US dollar up while depreciating the value of the yuan. This exchange rate differential allowed China to export even more goods at a lower cost because their currency was worth less. In return, they received US dollars for the products they sold, which were now worth more, providing China an even greater economic boost and advantage. These conditions were responsible for widening and creating a bigger trade deficit with the United States. And unfortunately, the United States has suffered as a result of this activity. But how did this happen? Before we dive into that, let's summarize the economic development that's happened in China in three ways. Number one, and most importantly, the economic boom in China was started by debt. However, the massive trade surpluses from the weakening yuan and China becoming the manufacturer for the entire world has helped support the boom by creating a trade surplus of profit. Adding even further to that fact is that low labor costs have helped fuel global development. China has been the producer for the entire world for the most part at a low labor cost, and other nations have enjoyed importing goods at a low consumption cost to their everyday citizen. But every single benefit comes at a cost, and this was the big cost of the United States and other economies that are net importers of Chinese goods. So now let's focus on the United States. How specifically has the United States been hurt and helped by the relationship with China since the early 90s? First and foremost, on the left-hand side, we're going to talk about how the United States has been helped by this relationship. Number one, the United States had access to cheap labor for US company production. Many US companies opened factories in China and put capital to work. This created an inflow of capital into the Chinese economy and help develop their infrastructure products and their labor market. However, it came with the benefit of getting access to cheaper labor than you could find in the United States. Cheaper labor results directly to a higher profit. The biggest cost of most corporations is employment cost. The staff around you at your 9-to-5 job or wherever you may work is probably what's driving the most amount of expense to your company's bottom line. So cheaper labor costs was a direct result of higher profitability for US corporations. Number two, cheaper products for consumption. As a consumer in the United States, goods came in at a lower cost because they were manufactured in China than the equivalent of that product being created in the United States. If everything consumed in your daily life was created, manufactured, assembled, and sold in the United States, the cost would be astronomical. And the third way that US was helped with the Chinese relationship, and by far one of the biggest, is the inflow of capital through treasury purchases. The surplus that China generated as a result of selling their goods to the United States was reinvested into the US dollar, and that flowed into the US Treasury bonds, which helped finance the government budget for the United States to invest in infrastructure projects and support the country. Now let's take a look at how this relationship has actually hurt the United States. Number one, and the most important, is that as a result of these manufacturing jobs being pushed abroad to China at a lower labor cost, the United States has lost the majority of the manufacturing sector. A lot of manufacturing jobs have in fact been lost in the United States. And this was a part of Donald Trump's core campaign for his first term election. Another downside is that because the products aren't made in the United States, the profit is also not going to the United States. A lot of corporations have opened up companies abroad and have received profit offshore from the United States and are not taxable by the IRS. This means it's created lower profitability and lower capital available to be invested domestically into the United States to grow infrastructure, to grow the entire economy, and that's had a big impact. As you'll remember, one of the biggest ways that China stimulated the economy and created a massive boom is by using capital that they've earned to invest domestically into their own country. A third way that the United States is hurt from the relationship with China is intellectual property theft. Because a lot of companies manufacture within China, a lot of the technology secrets and information is exposed in that process. This has been one of the downsides of the relationship. But at this point, it's very important to keep in mind that China and the United States have been trade partners for nearly 3 decades. And this relationship has had a lot of beneficial aspects to both countries. And in the process, both countries have had to sacrifice things along the way to build this relationship. While at the moment there's a trade war going on, when you look at the possible solutions, there are actually very few. And the scariest part may be that a real solution would require tearing down everything we already know and rebuilding a system that it took for China to perfect and implement over a 3-decade stretch. So what is the potential solution to this trade war that's currently ongoing? The first thing that's important to realize is that nobody will win. In war, there are casualties on both sides, and there's a price to pay in this situation. Both the United States and China will and are currently suffering economic damage in the short term. But that's just the short term. In order to eradicate this problem completely, we actually need a brand new system. The United States needs to start investing capital locally. They need to develop the economy as a whole. But the big question comes from here. Where will the money come to finance such projects when there's already a massive debt load and a big debt burden on the United States, to the tune of almost $21 trillion in total? With this debt comes the responsibility to pay regular interest rate payments to the people who finance the country. A lot of the debt is owned and owed by the US government, but roughly 35% of the debt is actually to foreign investors. So while the United States will need capital to rebuild the economy, it will still need to make payments to foreign partners such as China and Japan, because they are the 2 largest foreign holders of United States treasuries. As the United States starts to build new infrastructure, new projects, manufacture things at home, there's going to be a higher input cost at the very beginning. A new system takes time to implement and a tremendous amount of resources. During this change, costs will go up This will drive a lot of inflationary pressure, and that will have catastrophic results in the economy for the short and medium term. So a system that works without China will involve a brand new approach and possibly decades of technology and development, and possibly decades of development to replace the current lifestyle we have now. Because let's face it, what we enjoy in 2019 is convenience. With the touch of a cell phone, we're able to bring food to our door, we're able to order a taxi cab, rent homes, and do a number of other extraordinary things that weren't available 30 years ago. So all these benefits, all these conveniences we have around us have come at a cost. And this is why this trade war is not easy to have a clean solution. If there was an easy solution, it wouldn't have been a problem to begin with. The best scenario for the short term would be to balance trade, would be to find ways in order for China to be able to export their goods at a lower cost, but at the same time for the United States to maintain some manufacturing jobs domestically. One solution would be to target certain products and create those in the United States and have a look at what the results show. Because the moment production starts to happen in the United States for items that you start to consume, the costs are going to explode much higher. And the question is, can consumers shoulder an increase of that amount? I would love to find out from you. What do you think is the answer to this trade war? And if you were Donald Trump or President Xi from China, what kind of things would you bring to the table and what kind of resolution would you propose? Pop that in the comment section below and I'd love to hear more from you. I really hope you enjoyed this video and you learned about the current economic situation between China and the United States. If you want to read our blog with the latest developments, including market analysis and insight, click the link above or in the description and head on over. We update the blog regularly with every single trade war update and keep you posted and up to speed. We do the hard work for you so you can focus on your investments. If you enjoyed this video, please click the like button and don't forget to subscribe to our channel by clicking here and hit the notification bell so you know when we have new content. For our free training course, click here and get started now. I appreciate you. Thank you so much. Manage your risk and trade like a trade pro. Take care and goodbye.